Reed Hastings is out as CEO of Netflix, but the stock is popping after reporting Q4 earnings after the bell. What is going on, investors? Hopefully you guys are doing well out there, and hopefully you can make it through this video as my voice not 100%, but we've got Netflix earnings and we've got to get into them. Now, over the last year, stock's down 38%. Year to date, only, a couple of weeks, up 7%. But here's the story about Netflix. This thing has been on a rocket ship. Over the last 6 months, this stock is up 56%. And during the regular trade, people were kind of risk off, maybe taking some of those profits before the company reported their earnings. Stock was down about 3%, but now I'm seeing in the after hours, this thing is popping, getting all that back and more. Let's get into the numbers. The revenues came in at $7.85 billion, essentially flat. I mean, it was up like 2% year over year. You had a lot of FX or currency impacts on the company. We'll go through those when we look at the financials, but obviously being a multinational company dealing in Europe and dealing in Latin America and basically across the world, as you convert those currencies back to dollars, obviously can create a strain on your revenue growth and your average revenue per user as well. Now, the company really knocked it out of the park when it came to subscriber growth and even the revenues beating expectations. But it was those earnings, which came in at just 12 cents, essentially almost a rounding error from a dollar perspective, and that missed expectations by over 38 cents. We'll show that to you here in a moment. Now, we did get some guidance for the upcoming quarter for Netflix. Here's the change with Netflix. Those of you that have been following the company for a while know the company gave you global streaming kind of paid membership guidance. They were giving you guidance quarter over quarter, essentially, on how many subscribers they think they would get for the upcoming quarter. Well, the company's changed their business model just a little bit, switching kind of to a ad-supported model. So that might change the amount of subscribers that they have kind of on a more regular basis. So what they're doing now, they're giving you revenue guidance over at this company, and that guidance came in at $8.172 billion. That would be about 4% growth year over year. Expectations for the upcoming quarter was about where that is at. Obviously, a company like this that's constantly rebilling its customers. I know they've layered on ads. They've talked about it. They're still scaling that up, and they're, still trying to work that business and that revenue into their business model. So we're not seeing a huge impact likely of the ad-supported model yet, but basically in line with expectations, as the company has a steady amount of income coming in, with over 230 million people worldwide paying a monthly subscription fee. Now, year over year growth on that subscriber growth was over 4% and 7.66 million net paid ads. Folks, that was as many as we've seen in several quarters. It is a decline year over year, but boy, you went negative on that subscriber growth for 2 consecutive quarters over at Netflix, and that caused the stock really have massive declines. But they've done a nice job clawing that back, and that's certainly helping the stock over the last 6 months and certainly in the after hours as well. We'll get more into these numbers here in depth when we get to the financials, but we have a change of leadership over at Netflix. Now, for the last, I believe, maybe the last couple of years or so, I think Reed Hastings, who is, I believe, the founder and the CEO of Netflix since the beginning, has been essentially co-CEOs with Ted Sarandos for a little while now. Well, now it looks like this guy, Greg Peters, who was a chief operating officer, looks like he's stepping up also into a co-CEO role. And Reed Hastings is now just going to simply be the executive chairman at Netflix. There is some other shuffling within the company from a leadership perspective. You have all of these guys, Reed, Greg, and Ted. They have worked for the company, I believe, for 15 years or so. So this is not one of those situations where I'd be overly concerned. It's really a passing of a torch instead of maybe a true kind of leadership change. Now, come over here and look at the company. They are going to highlight that they have lots of foreign exchange currency impacts on the company. In fact, for the full year of 2022, they show you operating margins came in at 17.8%. That was lower than the full year of 2020. That was lower than the full year of 2021. But when you factor in an adjusted kind of constant currency impact, you will see that they had 20% operating margins. That is lower than it was last year, but it is in line with where you were in 2020. So if you factor that into the company, they are doing relatively steady when it comes to those operating margins. When you look at the regional breakdown breakdown over at Netflix. Obviously, the most important market from kind of an average revenue per user or membership is the United States and Canada. It has by far the highest amount that people are willing to pay for the content, to the tune of the average being about $6.23. Now, that was down a little bit quarter over quarter. Year over year, though, that is up about 10%. You like to see that, them be able to pass on these price increases. Now, revenue quarter over quarter basically flat, but year over year, you did have some growth there. From the paid membership side, you saw nearly 1 million people sign up for the service over the last quarter. Not as strong as Q4 of last year, but again, you had negative growth in that. And so to be able to basically re-accelerate that, actually very impressive over at Netflix. Now, Europe, Middle East, and Africa, the second highest average revenue per membership, coming in about $10.43. That was a decline, though, year over year and also quarter over quarter. So you're seeing maybe a little bit of pushback in terms of that. And that's where this ad-supported thing, while the ad rates in Europe and Middle East and Africa probably not going to be what they would be in the United States and Canada, it could help support this thing long term. At least that's what Netflix would want to convince you, or anybody that is bullish, the shares would want to convince you of. But what you did see again is a reacceleration in those paid net additions. Over 3.2 million people signed up for the service. That's as strong as you were last year in Q4 when you had about 3.5 million. And again, you had 2 consecutive negative quarters and then kind of a flattish quarter, kind of like an okay quarter. And then boom, a rapid acceleration into those paid ads. Tell you what, this company's doing a fantastic job accelerating. And then you've got Latin America, not as strong as ARPU on here at $8.30. That's essentially flat year over year and down a little bit quarter over quarter. But again, impressive paid net ads at 1.76 million. That is the highest mark that we had over the last previous 4 quarters. So strong growth there. Although Netflix is hitting their head on the ceiling, I believe, a little bit on how much they can charge, particularly in the markets outside of the United States and maybe Europe as well. This is where that ad business is certainly going to come into play, not in the shorter term, but I think you're looking at something 3, 4, 5 years from now certainly can really be beneficial for this company. And then you come down here to APAC, you had dramatic declines on that average revenue per membership. That was down 17% year over year, even quarter over quarter tremendously. But again, still strong. Paid ads at $1.8 million, not as strong as it was a year ago. This region never turned negative from kind of a paid ad perspective, but very, very strong results from Netflix. Then you come over here to the high level financials. You see something interesting here. You're going to see a company that didn't make no money. So revenues came in at that let's just call that $7.9 billion. Again, that was just 2% growth year over year on that revenue side. You had your cost of revenues really accelerate, and not really quarter over quarter, but even year over year. You're at, call that about 5.3. That ticked up to 5.4. What I noticed with Netflix is they really accelerated their marketing cost over quarter, particularly, but even year over year. Last year, you had 792, now all the way up to 831 on that marketing side. Your technology and development just staying within line. In your general administrative, what I respect about this company is year over year, your G&A line actually went down. That gave you operating income over at Netflix off of $7.9 billion worth of revenue. After we pay all our operating expenses, came out to just, and I say just, $550 million. Last quarter, it was a whopping basically $1 billion higher at about $1.5 billion. Now, last year, it can be something about the fourth quarter, okay? It could be something to do with marketing. You're just, spending a little bit more on the marketing. Ad rates tend to go up at this time of year. It could be having to do with their ad business as well. They're having to market that and spend some money there. The other thing that it can do from the cost of revenue perspective, it could be that some of the licenses on some of this content, it basically kind of rebills in this quarter, if you will, or the contracts are re-upped this time of year. And so I noticed last year, in the same quarter, they had, pretty unimpressive operating income of just $631 million. Well, it got even less impressive at $550 million. Pull all the way down to net income. If you pay the government their income taxes and other types of things, just $55 million worth of net income, which is basically nothing. And I believe you had a lot of FX or foreign currency impacts on this company's net income. That's where you get that pretty, very dismal low, 12 cents per earnings on the share. But I would just focus primarily on that revenue growth. They're holding where it's at. The company is investing in their ad business. They're investing in their video game business. They, on this slide deck, which I did not show you, they show that, they're still just capturing a small percentage of the market. And look, they are profitable. You look at Disney Plus, you look at any of the other competitors out there, and none of them are basically profitable operating their streaming business. So at least Netflix can hang its hat on that. The company is still relatively well capitalized, got over $5 billion in straight cash, got another 911 here. So you got, $6 billion in cash, another 3.2 in other assets. It's really these content assets. I mean, this is a content company. And so this is where you want to see all the assets. That's what I like about Netflix. This is where all the, basically all the honey is with this stock. Nearly $33 billion worth of content assets. That's up from basically a period ago at when they were about $31 billion. They talked about their long-term debt. They do have a little bit of that here on the balance sheet, coming in at about $14.4 billion, down just slightly from where you were a year ago. I believe in the slide deck, they say they don't have really any of this due this year, and just, I think, maybe 400 or 500 million of it due next year. So not a lot is going to roll off on the debt side. Really, the way you probably want to analyze, or one way you can analyze Netflix and get a better sense on how this quarter was in comparison to maybe the third quarter and certainly last year, is come over here to cash flows. So you pull down a very low net income number. I mean, we're talking about tiny numbers, considering last year you're at 607, last quarter you're at 1.4 billion, and now you're down to just $55 million, which if this company dropped on the ground, I don't think investors would really notice. Now, on the cash flow statement, you do get to add back in these content assets, because the way you monetize and amortize the content assets is a little weird when you look at it from an operating perspective. So if they buy the rights to like Seinfeld and they have to pay like $1 billion for that or something like that, well, they have to recognize that in right when they pay Sony or whoever owns the rights to that TV show. They have to pay that all up front, similar to like making a movie. You pay all the cost of operating and producing that movie before it makes a dime, and then you make money on that asset over a longer period of time. So that's why when you come over here to cash flows, you see the additions of content assets on here, but you also see the amortization of those content assets, and you are seeing that those essentially usually come very close to canceling themselves out. And in fact, in this quarter, that's essentially what they did. You have stock-based compensation on here. You have that large foreign currency remeasurement, or the foreign currency exchange rate, that certainly skewed operating profits. And so you flow through all those add backs and subtractions. You get net cash. Basically, your cash provided by operating Netflix came in at $443. Last year, you actually lost $403 million. And you see, here's where it's really comparable. Quarter over quarter, you went from $556. Again, off of net income of $1.4 billion, you flow all the way down to cash flows. They're actually relatively similar, from $556 down to $443. That's why investors are relatively excited. Now, it was actually a heavy investment quarter for Netflix. Purchase of property, plant, and equipment up to $111 million. They purchased some short-term investments, but really this acquisitions as well, coming in north of $560 million. So that is where you had a little bit of cash burn over the last year to the tune of, we'll call that $970 million. Now, when we come over here and look at this from a technical perspective, I am seeing in the after hours, you're up about $20. So we've more than made up for the decline in the regular trade for Netflix. It was down about 3.2%. Now it's up 6.5% in the after hours. If you follow our channel and watch our Friday show, you know we've pulled up the chart of Netflix every Friday, and we'll certainly do that again tomorrow if my voice will hold up. But I'm actually on a weekly chart. It kind of condenses the candles, makes actually the upper trend lines look a little cleaner. Now, look, this stock has been on a massive decline. If you bought this stock at a higher price, you're still feeling the pain, but really, there's probably not that many people that have been holding this one at a higher price, you've had a massive move in the stock from the lows that it made back here in May, and that's maybe not the exact lows, but close enough, right? To the top where we are, you have made a 100% move in this stock in less than 1 year. This is things that should really get investors really excited, as even with all the macro discussion and all the stuff that goes on, you can have stocks like this move 100%. Now, we are reaching an area of resistance right where the stock is. Doesn't shock me at all. In the after hours, we're hitting our head right here at 337. That was essentially where the stock was before it reported earnings several quarters ago, as it had a massive drop and has basically gotten it all back to the tune of 100% gain. This stock is locked in an uptrend. Folks, when you see your stocks like this, they're making higher sets of lows, higher sets of highs when they dip, when they pull back. And that was kind of what I was hoping for with Netflix today. I was hoping maybe they put up a little bit of a stinker. You get a pullback to 290, you get a deeper pullback to 250, a big one down here to 230. You can buy these. I don't know about this like big one to 230 because you take out these lows, but any kind of pullback in Netflix in this uptrend is a buying opportunity to just understand for this stock to push higher than where it's at right now, 320. It's a little bit of a challenge given the fact that this is where the stock stalled out before its initial drop after that subscriber growth started to turn negative. From a technical perspective, things look pretty darn good over at Netflix. The subscriber growth has not reaccelerated to where it was, but it's reaccelerated to a range that I don't think investors were really highly anticipating. And the leadership structure over at Netflix, while it is changing, certainly still has Reed at the top, and he's working with people that have seen the success and been a part of the success for Netflix for a while. And then obviously you have that advertising tier that is just beginning over at the company, which I believe Reed Hastings said he wished he started a long time ago. In subsequent quarters, hopefully we get a little bit more detail on that and a breakout of those revenues at some point. Hopefully you guys have a wonderful day, and we'll see you again tomorrow where we'll talk a little bit more about Netflix on our Fraying Stock Recap show. Hopefully you guys have a great day. Good luck with your investments.